Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, a historic media shakeup as Netflix agrees to buy Warner Brothers Discovery. Details on the $72 billion cash and stock deal throughout the hour.
Plus, continued clash between the US and the EU on free speech as the European Union finds Elon Musk's X platform $140 million.
And HPE's outlook disappoints on slower AI server deals. We speak to the CEO. Let's get right to it. Netflix buying Warner Brothers Discovery. The value of the deal, $72 billion. Warner Brothers Discovery shareholders set to receive $27.75 per share in cash and stock. The value of the deal, or value of Warner Brothers, almost $83 billion when you take into account debt. This is going to go on for a while. The expectation is it could close within 18 months. A lot of questions, Caro, on the why and also about the price when you consider the bidding war that was going on for this name.
And this is for streaming, this is for studios only. Earlier today, Ted Sarandos spoke on a conference call, Ed, about this deal. Here's what he had to say.
I know some of you are surprised that we're making this acquisition, and I certainly understand why. Over the years, we have been known to be builders, not buyers. We already have incredible shows and movies and a great business model. And it's working for talent, it's working for consumers, and it's working for shareholders. But this is a rare opportunity. And it's going to help us achieve our mission to entertain the world and to bring people together through great stories.
Bloomberg's Lucas Shaw, who leads Bloomberg's coverage of media and entertainment, joins us now. And Lucas, those exact words, builders, not buyers, was exactly what Greg Peters, the other co-CEO, said to you on a stage but a few months ago. Did it take you by surprise?
By this point, no. It's funny that you asked that. I've spoken with a few different people at Netflix this morning, and they all asked me if I was surprised or shocked. And it's true that they've never done anything like this before. It represents a huge change for the business. It'll, if this deal gets through, and I know we may get there, it'll double in size pretty much as soon as they add all these folks. But Netflix has always been a company where they kind of never say never. They say they're not going to do something, and then they end up doing it. And it's been obvious over the course of the last 2 months, really since Greg's appearance at Screen Time, my confidence this would happen has increased bit by bit, including as people from Netflix told me that they were getting more and more serious about it.
Lucas, I think there's a lot of reporting to do here on Bloomberg Tech, especially for the audience members that are hearing about this deal for the first time. What is Netflix proposing to do with Warner Brothers Discovery? What does Warner Brothers Discovery plan to spin out? Because there's an element that they'll have to divest or start new companies of some things. And we're reporting that in this bidding process, Paramount came in with a $30 per share offer. So it sounds as if Netflix had a lower offer than Warner Brothers Discovery went with.
I'll take him in 3, although I will say though, that the Warner offer, or the Paramount offer was not technically higher, but I'll get into it. So the process is Warner, assuming that this all continues as planned, Warner Brothers Discovery will spin off its cable networks, the CNN, TNT, TBSs of the world, sometime third quarter next year. They will then proceed with closing the sale of the rest of the business, which is the Warner Brothers Studio and HBO/HBO Max streaming, to Netflix. They expect that transaction will close in the next 12 to 18 months, so let's say sometime in 27. And then there will obviously be, regulatory approval and all that, which could also drag on for some time. Depends on when that enters the equation.
Right.
In terms of the value and all that, yes, Paramount offered $30 a share. Netflix was just shy of 28. But you have to remember that because Netflix is only buying 2/3 of the company, there is a value that is being applied to the business that will be spun off that you add on top of the Netflix bid. So a lot of whether the Netflix bid was more or less than Paramount depends on the value you assign to those cable networks. People who are really skeptical, and certainly folks I spoke with in the Paramount orbit, are like, those cable networks are worth nothing, maybe $1 a share, maybe $2. Warner Brothers may argue it's worth $4 or $5 a share, in which case the Netflix offer is actually higher.
Bloomberg's Lucas Shaw, who leads all of our coverage of this industry at Bloomberg with the key details you need to know. Thank you very much. Let's get more on the deal and the potential resulting media landscape shakeup with John Klein, Hang Media co-founder. John, with respect, a veteran of the media industry in this country, former president of CNN, a serial founder of media companies, modern-day media companies. Lucas talked about what happens next, and the expectation, I believe you share this view, is that this will go on for many months. There will be challenges along the way in the antitrust context.
This is going to be a saga that plays out longer than Game of Thrones did, because, not only do you have shareholder issues, your questions potentially, but you've already got the creative community in Hollywood rising up. The Directors Guild wants to sit down with Netflix. The theater owners are worried that Netflix is going to severely reduce, movies released in theaters. Overall, it reduces competition for producers and writers radically. And then, of course, the biggest factor is going to be the political aspect. Not only does David Ellison's dad, Larry Ellison, who has funded the Paramount takeover, have a close relationship with Donald Trump, who I think had been licking his chops at the idea of combining CNN with CBS News, which is already trying to veer a little more to the right. But you have that in play. But then you've got Gavin Newsom, who's the entertainment economy drives so much job growth, revenue in California alone that I'm sure he's going to get involved in this as well. So it's so buckle up and stay tuned. And maybe at the end of the day, what WBD ends up with is the $5 billion kill value of this deal. We'll have to see.
I mean, that's an extraordinary, of course, unwind value that they're offering, saying if this doesn't get through the regulators, we will hand you $5 billion, Warner Brothers Discovery, more than. But John, I want to go back to how Netflix is already trying to front run this. They're already saying these are complementary strengths and assets. They're already saying there's going to be more choice, greater value for the consumer because you're going to get bundling and maybe a cheaper offering. They're saying this is a stronger entertainment industry because they're actually going to be leaning into theatrical releases. Do you buy any of that?
Oh, I buy some of it. We just don't know how much more consumers are going to have to pay for this new and improved, bigger, better than ever, one big, beautiful streaming company. And so we'll have to see that. But bottom line, there are going to be fewer buyers for creative product. Also left begging in this, though, and I think it's really worth talking about, especially on a tech-focused show. Netflix's biggest problem is not market share versus Amazon or Disney Plus or what have you. The bigger problem is YouTube. YouTube commands far more viewing time, almost double the viewing time that Netflix does right now. And Netflix has been busy trying to poach YouTube creators. But what's really happening in the entertainment industry as a whole is this flood of creator content. And this deal does nothing to address that.
Yes.
They could have spent far less money and bought a creator studio that could very well have a much larger impact moving forward than gaining some really great titles. I mean, the IP of Harry Potter and Friends, that alone is worth a lot of money to.
So what we're debating here is value, right? This is where Warner Brothers Discovery is trading. I'm just making a sort of mechanical observation. The share price is around $25 a share. Guys, give me Warner Brothers Discovery for a sec, please. The Netflix offer is $27.75 a share, which Lucas explained gets you basically 2/3 of the business. You seem to be questioning the value. The shares aren't even trading at a kind of level that reflects 2/3 of the business. I'm trying to do the math here on whether this is a deal that the market is saying, yeah, we think this is a fair value, a good value.
I don't think the market has grasped the tidal wave that is being unleashed even as we speak and is only going to grow thanks to AI, which puts more tools into the hands of more creators. And so I think there's going to be a reckoning at some point, not this week, not maybe this year, over the next 12 months, but that's what's happening in the entertainment industry. So this could end up being looked upon as one of the last great old media deals. And it's ironic to call Netflix old media. But this, and I'm not saying they're blind to the challenge of YouTube or the creator opportunity, but it's placing a value on something that used to have a lot more value than it is going to have moving forward.
John, what's so great about you is because you're building Hang, which is all about Gen Z interacting with brands, because you built an AI business that you sold to Apple, you are in the new media, but you also did help run CBS and CNN. What does it mean for TNT, for CNN? What does even that part of the business have value? Do you think it has $2 value or in excess of? Was it a miss, therefore, for Paramount Skydance?
I would be shocked if David Zaslav is not working the phones this morning, drumming up buyers for that entity that he's going to spin off. He's been masterful at discerning what parts of his empire are valuable to whom. And there is still value in those linear networks, let's say to a Versant, which just spun off its linear, or is about to be officially spun off from NBC. Sinclair and Nexstar, the massive and growing local broadcasters, might be interested in becoming both, right? So there are potential buyers out there, and Zaslav may have just figured, look, the sum of the parts is actually greater than the whole, if I do this right.
John Klein, Hang Media, it's great to catch up with you again. Really appreciate it. Now, coming up, as the EU, it finds Elon Musk's social media platform, X, and President Trump warns that European civilization could be wiped away. We sit down with the EU ambassador to the United States. You don't want to miss it. This is Bloomberg Tech. Elon Musk's X social network has been fined 120 million euros, that's $140 million equivalent, for violating an EU content moderation law. That rule is already a point of contention between the bloc and the White House when it comes to tech regulation. Joining us to discuss the Bloomberg Tech editor in London, Olivia Solon. What exactly was their issue in the EU? Which law did it go against?
So the law is something called the Digital Services Act, which is a kind of new rule book for digital platforms across Europe. And the main thing that the Commission took issue with, that they fined Elon Musk's X for today, was three things. There was the blue tick and the fact that it was changed to a paid feature, where it used to be a sort of sign that someone was a kind of authority on something. Then they'd also stonewalled giving researchers access to data, and they didn't set up an advertising repository that provided transparency to researchers either. So the fine today was kind of generally smaller than people had expected, but there are still some other issues that the Commission's investigating, some more kind of serious issues around how it polices illegal content, election disinformation, and its community notes system for content moderation.
Bloomberg's Olivia Solon, our tech editor in Europe, thank you very much. Earlier today, the US ambassador to the EU, Andrew Puzder, accused the bloc of unfairly targeting the biggest American technology companies. His comments on Bloomberg Television came just moments before the penalty on X was announced.
The only substantial, meaningful fines that have been imposed so far have been against American companies. So at some point, if you're an American company, you've got to sit back and say, look, am I being targeted here? Or is this an effort to try and advantage European competitors over U.S. companies? And if that's the case, it's something that the United States needs to respond to. And I believe the vice president has been very active in that respect.
We're joined now by Jovita Neljoshena, the EU ambassador to the US, here with us in San Francisco. And Ambassador, to start, I'd welcome your response to your counterpart, the US ambassador to the EU.
Good morning. I think that what we are discussing right now, it's non-compliance case, and it was very well summarized. There's the question about their advertising, the access to the data of that, the access to the data for the researchers, and the deceptive mark of verified content. So I think that this is really very clear. Now the X has a certain amount of days to prepare the plan of implementation, and we will take it from there.
Broadly, Ambassador, US officials, including the president, just believe that EU rules are too onerous on American technology companies. One of the reasons you're here is to attend an event about the US-EU investment bridge. Secretary Lutnick has said if we're going to do some deals on certain tariffs and sectors, then something needs to happen and change with the digital rules that the EU has.
Look, I think that EU has a right every time you have a business in Europe or the business in any other jurisdiction, you apply the rules which you are supposed to act. I think that this is our sovereign right to regulate. This is one element. Another element, some of the search engines digital search engines which are functioning in Europe, some of the platforms have more users than US has citizens in Europe. Some of the digital companies, American digital companies, have 30 to 50% of their turnover actually generated in Europe. So probably we're doing something good in Europe to make sure that American companies would feel welcome and actually see the benefit of being there. And I think that in general, be it trade, be it technological cooperation, be it cooperation on economic security, or be it both sides investments, I think that on the both sides of Atlantic, this is the thing that should be actually mutual beneficial. It should be beneficial for both US and EU.
Thus far, certainly the administration doesn't feel that, Ambassador. We're having a post from Marco Rubio talking about how this isn't just an attack on X, it's an attack on American tech platforms and on American people. As you sit down and meet across the board, you go into an AI impact pre-summit, for example, what are the sorts of narratives you can come back with to say this is the right due diligence, and indeed we embrace American tech companies in Europe?
Well, as I mentioned, we have multiple American companies. We have multiple companies from other parts of Europe. We have European companies active in our 450 million of market. Everybody has full access to that. And our regulation is never. Our regulations are never targeting one country or one specific company. It's really geographically neutral.
What's interesting is you're here not just in San Francisco and visiting. You're then flying to LA to an event in Simi Valley that we're going to both be at, the Reagan Defense Forum. And what's interesting at the moment is there is a view, in particular, a white paper that the EU, have put forward, really unveiling the commitment of the European Commission to spending on defence. What has the reaction been from the United States thus far? Have we seen the US think that enough is being done? And can you get access to the right US defence tech?
Well, I think this is what actually was asked from us, and we were encouraged as the European countries to invest as much as possible to our security and defense, and this is what we're doing. NATO member states NATO allies will spend 5% of their GDP. European Union is actually spending extra on top of that to make sure that we incentivize our defense industry back home. All in all, it will be more than 900 billion in 3 to 5 years. I think that's a huge amount, and we are not really spending that to spend. We want to build our capabilities, which we have to step up. We don't have them now, or not enough, and we are not planning to do that alone. The cooperation is extremely important. That's why we're here. We have an investment bridge event today with our European Investment Bank, and looking for the core investment projects, not only some the projects which would be beneficial only for us. I think that this is the idea.
Ambassador, back in Brussels, the German Chancellor is trying to secure a deal for immobilized Russian assets to help Ukraine. What is your sense of where a deal is, if it can be done, and what America's attitude is towards it when you speak to your counterparts?
So, European Commission presented legal pathways how the immobilized assets can be turned into the reparation loan and the loan for Ukraine with a long-term commitment to support Ukraine, because we need to make sure to ensure our own security, which includes as well a Ukrainian security. This is one element. And we believe that the country which actually wages the war have to face the consequences.
But America is supportive of this effort. What is your sense?
Well, this money actually is in a European account. It's in Euroclear. So I think that's the decision of the European countries.
It's been wonderful having time with you. A decisive answer there, EU Ambassador to the US, Jovita Linovskiena. We thank you and have a good rest of your visit. Meanwhile, coming up, SoftBank, well, it's in talks to buy AI infrastructure giant DigitalBridge. More on that next. Shares up 30%. This is Bloomberg Tech. Time now for Talking Tech. First up, one of China's leading AI chip makers, More Threads, jumped 425% in its Shanghai trading debut. The startup drew strong investor interest in its IPO, with the retail portion oversubscribed by 2,750 times. Now, More Threads joins Camericon, Huawei, racing to fill a market void after Nvidia was, of course, forced to exit China. Plus, SoftBank, well, it's said to be in talks to acquire DigitalBridge, a PE firm with heavy investments in assets like data centers, that's according to sources. Now, the potential deal builds on SoftBank's efforts to take advantage of an AI-driven boom in digital infrastructure. A transaction could come together in a matter of weeks. And BlackRock's iShares Bitcoin Trust recorded its longest streak of weekly withdrawals since its debut back in January 2024. Look, investors yanked more than $2.7 billion from the ETF over the 5 weeks to November the 28th. The ETF is now on pace for a 6th straight week of net outflows. Ed.
Okay, coming up, Bitcoin is in the red this year, while the S&P 500 is higher. It's the first time in over 10 years that's been the case. Our top story throughout the hour, you know it, Netflix buying a big old chunk of Warner Brothers Discovery. This is what the share reaction's like in the moment when you talk about antitrust, when you also talk about debt, and all that's to come. This is Bloomberg Tech. Welcome back to Bloomberg Tech. Our top story, Netflix buying a big chunk of Warner Brothers Discovery. This is what shares look like right now. This is a $72 billion cash and stock deal where Warner Brothers Discovery shareholders get $27.75 per share. I say a chunk because Warner Brothers Discovery will spin off cable networks, think CNN, think TNT, into a separate company before the transaction closes and goes through. But it means that Netflix, this kind of modern day streaming giant, is getting one of the oldest studios and developers of content in Hollywood. There is a lot of consideration around this deal. All I'll say, Caro, is that the parties have done some interesting things here as part of the bidding war. Meanwhile, in Washington, the proposed deal already facing some backlash. Democratic Senator Elizabeth Warren issuing a statement calling for the DOJ to enforce anti-monopoly laws, saying the Netflix-Warner proposal is, quote, a nightmare. Let's bring in Bloomberg's Michael Shepard from Washington, D.C. There's the congressional review, and the Democrats will have some view on this, of course. But then it's probably more important to say, what is the White House view of this? What are policymakers' view on this?
Well, the policymakers are really being egged on by Congress, and not just by Elizabeth Warren. We're seeing Republicans, including California's Darrell Issa, get into the act, and he is flagging his concerns on the consumer side. And really, it would fall to the Justice Department to conduct this review. Our expectation is that the agency's antitrust division will give this transaction the wire brush treatment. It will not go through the review process very easily. The biggest concern, Ed, really is around the streaming question. Of course, Warner Brothers has its storied movie studios and deep library of film and other productions, but it also owns HBO Max, which is the fourth largest streaming service in the world, to Netflix's number one. So when you combine those, that would give Netflix, following this deal, 30% control over the global streaming market, 450 million users worldwide. And that would attract a lot of attention from regulatory authorities, not only here in Washington, but in the European Union as well. One of the things that our analyst here at Bloomberg, Jennifer Ray, said is that perhaps Netflix, to make this deal more palatable, could let go of HBO Max. But Netflix has already tried to inoculate against that, saying that, look, 75% of our users also subscribe to HBO Max. So there may not be that sort of conflict when it comes to competition, as some are raising, they say.
Yeah, and maybe they can bundle it and make it cheaper as part of the argument for the consumer. We could go so many directions, Mike, and we could look to California and the impact on the industry and on jobs, and I'm sure that's something Gavin Newsom's looking at. But where you sit, many are wondering about the counter-argument likely to come from Paramount Skydance and, of course, the close ties with David Ellison, his father Larry Ellison, and the administration. What are you reading there?
Well, Kara, I'm glad you asked about this, because the politics these days are inescapable, and especially when it comes to this transaction, because in choosing Netflix as its partner here in this deal, Warner Brothers is jilting David Ellison, and that really does prompt perhaps a whole new level of scrutiny and a perhaps full court press with the Trump administration, with whom he is close, and also with perhaps the president himself. So there will be a lot of jockeying behind the scenes, perhaps even more so than usual when it comes to a deal of this nature. And one of the things we'll have to be watching is to what degree the Netflix side is also trying to curry favor, in effect, with the Trump side. Over the years, Netflix founder Reed Hastings has donated heavily to Democratic causes. He contributed $7 million to Kamala Harris, $20 million to Democrats over the years. But we also want to see how Ted Sarandos, the CEO of Netflix, is trying to do his part. And we know that in December, he did have dinner with Donald Trump at Mar-a-Lago. The men sat for several hours and talked. In March, Sarandos described the conversation as a good conversation, but we will need to see where that leads. We've seen how Jensen Huang of NVIDIA has parlayed that kind of a close relationship with Donald Trump into actions by the government that work a little bit more in his company's favor. So that sort of interpersonal diplomacy with the administration will be key here.
Yeah, co-CEOs, I'm sure, trying to work the phones. And I'm sure many will be trying to remind everyone that YouTube's a pretty key player in all of this as well when it comes to the regulatory impact and competition. Bloomberg's Mike Shepard, thanks so much for joining us. Let's pivot a little bit. Let's take a look at what's happening in crypto. Suddenly seen a bout of selling. We're off by 3.7% on Bitcoin, 88,760. As we move towards the end of the weekend, maybe some institutional money just putting things on pause. The digital asset, though, look how it's performed this year. For the first time, it's actually sort of diverged from the S&P 500 since 2014. These aren't moving in lockstep. Let's get more on this with Aya Kantarovich, his August co-CEO, co-founder, joining us now. You have so much experience when it comes to Falcon X, where you previously were, your secure software company, August. And look, Bitcoin's decoupling from stocks. What's it telling you?
Look, I think without a doubt, the last 3 weeks have been painful. You know, we've seen 1.5x times higher volatility in the last 3 weeks than we've seen in 2025 total. And a lot of that has to do with a number of things. One, there's implications, outside of just macro, which is, more global and geopolitical. And we're seeing a lot of bit of that. We're also seeing, some decoupling into the weekend, where we are seeing sell-offs into the weekend and then buybacks back into Monday, as you referenced earlier. And then last, we're seeing rotations back into, macro. And so, for example, sometimes people have to sell off their risk assets in order to reposition into those macro assets. And I think that's what we're seeing a little bit here as well.
The data set that keeps flashing up on the Bloomberg terminal, Caroline did it in the news story belt earlier, is the ETF flows, outflows at the moment. I'm just trying to use that data set to understand the psychology of everyone that participates in this industry. What is the interpretation we should make?
Yeah, so look, I think more broadly, Bitcoin operates in 4-year cycles, and we're seeing that 2025 is actually more similar to a 2021 or 22 in comparison to a 2020, 23, and 24. And what's tough is, in those years, we really saw a strong December, especially. And, you had the post-halving liquidity surge, you had recovery from FTX, and ETF optimism. And then in 24, you saw the ETF, inflows coming in size. And so, we've seen this cycle before. We've also seen historically this year a lot of very long-term holders take some profits off the table, and we have seen some patience. And so I think you're seeing some of that profit taking into year end. We're going to continue to see that, but it really does make Q1 look very attractive as we do close out on that 4-year cycle. And we have a lot of the headwinds that will take us there, whether it's the Vanguard news, whether it's the Bank of America news. We are looking to see new entrants come into the market via the ETFs.
Talking of long-term holders selling, there was suddenly a shock to the system when it was thought that maybe Michael Saylor's strategy, artist formerly known as MicroStrategy, might actually offload Bitcoin. The hodler of all hodlers, sort of saying the most extraordinary thing to many who've been in this market for a long time. What did you make of that and their desire to try and stabilize after that moment?
Look, I think at the end of the day, he is probably feeling some of the pressure that some of these other institutional players are feeling, which is diversification and having to manage some of that downside risk. And if you do have leverage, having to manage your margin calls. And so at the end of the day, was that a great headline for the space? No, of course not. But these things operate in cycles, and we are at the end of that cycle. That also was announced before the Vanguard news and before the Bank of America news. And so, I think there are, again, headwinds into Q1, but I agree with you. I think, looking at where we are and then the next 3 weeks into year end, it's probably not going to be as optimistic, but means that 2026 can start that news cycle over again.
I'm probably going to take most of the rest of the year off, just share that with the audience. And so it might be my last chance to ask you for your 2026 predictions. This year has kind of been about stablecoin legislation, David Sachs, dollarization. If you were to listen to Jamie Dimon, he will always bring it back to the underlying technology and the utility of blockchain in global financial markets. What do you think will happen next in 2026?
Look, I think what people haven't realized yet is tokenization of everything is happening. And it started with stablecoins, as you mentioned, but it's going much broader than that. So if you look at even equities trading on chain, you saw the Mag 7 come to Hyperliquid. That was, following NVIDIA's earnings, one of the largest days of volume for Hyperliquid in November. And so you're seeing a lot of that come on chain, and you're also seeing a lot of traditional assets get tokenized. And so, we're seeing on our side a lot of tokenization of assets, strategies, vehicles, and then the liquid markets to make them composable and more capital efficient.
It's always great to catch up with you. I'll still be here for the rest of the year, so hopefully I'll see you then. Aya Kantorovich, August co-CEO, co-founder, we thank you. Coming up, HPE CEO Antonio Neri joins us to discuss the company's earnings and, well, a delay perhaps in some of those AI server deals with governments. That's next. This is Bloomberg Tech.
Shares of HPE are now basically flat, had been lower after the company announced third quarter earnings, noting that some deals for AI servers have been pushed into 2026. Delighted to discuss HPE's earnings with the company's president and CEO, Antonio Neri. Antonio, we're actually getting a really good insight through HPE into what's happening in real terms in the real world of data center build out. We had it with CoreWeave just a few weeks ago. A part of this, right, is a delay on a specific data center project. And you can't book revenue until that project goes ahead. Is this a one-off? And if you could, just explain to the Bloomberg Tech audience what is in your power to control and what is still happening out there in the supply chain for data center build-out that's holding things up.
Well, good morning, Ed, and thanks for having me. Look, in Q4, we posted a record profitable quarter where we saw revenue growing 14% and profit growing faster at 26%. And that allows us to exceed both EPS and free cash flow guidance, so capping a very strong year. But on the AI front, we continue to see strong demand. We booked another $2 billion in orders. More than 60% of our orders are in sovereign and enterprise. And as you stated, there were a couple of deals that slipped into 2026. One of them was for data center readiness, was slightly delayed. And two were because of the U.S. government shutdown. We couldn't deliver the system and get it accepted. But in general, sovereign are longer, right? Longer sales cycle, longer acceptance cycles. But we are intentional on that because, we are focused on profitable growth in AI.
Yeah.
And now we have a backlog, which is over $4.7 billion. So ultimately, it can be data center. It can be also customers speaking different technologies like Vera and Rubin and maybe waiting for AMD. But the reality is that there is more back-end loaded. That's why we guided a year the way we did it. But ultimately reaffirming a 17% to 22% revenue growth guidance, in addition to raise the EPS and free cash flow guidance.
That data center lumpiness and indeed the hold-up that you saw, what is it? Is it supply chain issues? Is it cooling? Is there something that tends to be the holdback?
It's a combination of many things, Caroline. I think sometimes, just the real estate takes time. Bringing the power and cooling takes time. In some cases, the equipment, right, slightly delayed because you're talking about turbines for, power generation. Some cases, it can be low-level components. But look, these are very large build-outs. We're talking about, tens of megawatts, sometimes hundreds of megawatts, and now we're going into gigawatts. And so we just need to recognize that it takes time to build these large data centers. And ultimately, we will be ready to deploy as soon as these data centers are ready to accept the systems. But also the working capital takes also longer to get through.
So you just referenced Vera Rubin, and I'm trying to understand what you meant there. NVIDIA has this, we've discussed it, Antonio, several times, this commitment to annual update to the technology. And are you saying that there are customers out there that just want to wait for the latest gen before they commit at scale to a big project?
Well, or there are customers already in the current generations, that are generations before, that feel now, I need to get another bump in performance so that I can lower my cost per token training as I go forward. So it can be a combination of both. And depending on where they are in the build out of the data center, it makes sense for them to go to the next generation. But also we see an interest, in getting the choice and the flexibility to build these data centers the right way. And that's why, we at HP now, with the addition of Juniper, we are becoming a networking-centric company. And this past week, just in Barcelona, I came back yesterday, we announced a number of amazing technologies that allows customers to adopt, whether it's NVIDIA or whether it is AMD. And we announced the first scale-up Helios switch that allows them to adopt this technology. So it can be a combination of things, depending on where they are in that build-out cycle.
Our Bloomberg Intelligence analyst, Woo Jin Ho, always loving the diversification of the business and the leaning into the networking, Antonio. But just going back to with the data centers and the margins, that's always been the question. Like AI servers, the cost is memory. You seem pretty confident. Why are you confident on just having the handle on the shortage that we've got in memory?
Yeah, absolutely, Karen. Well, look, I'm very pleased that we returned the entire server segment, inclusive of AI, to approximately 10% operating profit in Q4, which was our commitment since Q1. And regarding cost of commodities, we need to recognize that the cost of commodity will be driven by the shortages we are going to experience in the latter part of 26, starting the second half, particularly in DRAM and obviously as well NAND. And we already enacted price increases in the month of November, and we already factor what we think is going to happen, at least the best line of sight we have in our guidance. And that's why not only we reaffirmed the revenue guidance, but we also raise our non-GAAP EPS guidance, considering what we see going forward.
Antonio, I'm really interested in the differences in the demand profile of say, Vera Rubin and against Helios. Helios, the pitch is its scalability, but are you getting more interest there at the edge in terms of use cases? Just trying to explain the real world differences of what you're seeing among your customers.
Yeah, I think, enterprises are accelerating adoption. I give you my own example here at HPE. We already have 100 plus use cases in production using AI across a number of functions and business units. And obviously, we use AI for our own products, which is one core differentiator for us in the market. But in terms of where the work is being done, is done everywhere. But we see now the growing in inferencing, which tells you that AI is being deployed. And there are a lot of use cases, whether it's manufacturing, transportation, healthcare, where the inferencing is cheaper at the edge, where things takes place, where the data is generated. And then obviously it's the training aspect, which can be a combination of locations. And in Europe, for example, this concept of sovereign AI clouds is super important because they want to preserve their sovereignty from a model perspective and the data. So it's a hybrid design by design. And that's why I always say AI is the true definition of a workload.
We love deep diving with you. Antonio Neri, thanks for joining, President and CEO of HPE. Now coming up, Netflix. It's lined up nearly $60 billion in loans to finance its takeover of Warner Brothers, one of the largest bridge loans ever. Details next. This is Bloomberg Tech.
Back to our top story, Netflix buying some of Warner Brothers Discovery. Netflix lining up $59 billion of financing from Wall Street banks to help support its planned $72 billion cash and stock acquisition of Warner Brothers Discovery. Bloomberg Intelligence media analyst Geetha Ranganathan joins us with the in-house take. What is the BI view? How good do you feel about the financing of it? And I know you have some thoughts about what could happen next.
Yes, so from a financing standpoint, obviously Netflix right now has about 0.4 times of a net leverage ratio, which is way below, media peers like Disney or a Comcast, for instance. But again, this is a company that has an absolutely robust balance sheet. And as my credit colleague Steve Flynn constantly says, this is a company that throws out billions and billions in free cash flow. So absolutely no problem. Yes, their leverage will go up to about 3 times, but that shouldn't be a problem. We do kind of anticipate them deleveraging pretty quickly, just given that they're going to be generating something like about $9 billion of free cash flow this year, and something like maybe about $13 to $16 billion in 2026, 2027. So financing really doesn't look like much of a problem at all, Ed.
What, therefore, is the problem, Geetha, if there is one? Is it regulators? Is it Paramount, Skydance fighting back? What do you think?
All of the above. Regulators, definitely. So just, from first glance, you have the #1 streaming service in the world combining with the #3 streaming service, which is HBO Max. And that just gives them unmatched scale. We're looking at 450 million global streamers. Obviously, that is going to raise a lot of regulatory concern. But I think Netflix can fight back by saying, it really depends on how you define the market. Is it are we just looking at Netflix, Disney Plus, Amazon Prime, or should we be looking at Netflix versus YouTube versus Reels versus TikTok, versus Facebook? So how do you define the market? And if you look at it from a much broader perspective, then the Netflix and HBO Max combination, it's less than 10% of total US viewing time. So maybe it shouldn't really, generate too much of regulatory backlash. So again, it all comes down to how the antitrust authorities are going to view this transaction.
I have a feeling it's going to play out over many months, even years. Geetha Ranganathan, we thank you so much for Bloomberg Intelligence with the immediate reaction to a pretty blockbuster deal, Ed. That does it for this edition of Bloomberg Tech. What a way to finish the week.
Don't worry, we're going to be talking about this for months and years. And that's something to look forward to. But there was a lot of serious reporting and detail to recap on that deal. Check out the podcast, best place to find it. You know where to find it, on the Bloomberg Terminal and online on Apple, Spotify and iHeart. From New York and San Francisco, have a great weekend. This is Bloomberg Tech.